initial public offering, IPO, is the process by which a private company sells its shares to the public for the first time to raise capital. This pivotal event marks a company's transition from private to public ownership, allowing members of the general public and institutional investors to buy a stake in its future growth. Think of it as the moment a company goes public and lists its shares on a stock exchange, like the Bombay Stock Exchange, BSE, or the National Stock Exchange of India, NSE, here in India. Here's a breakdown of what an IPO entails. Raising capital. The primary reason for an IPO is to raise significant funds. The company sells new shares, and the proceeds go directly into its coffers. This capital can be used for various purposes, such as expansion, research and development, debt repayment, or acquisitions. Becoming publicly traded. Before an IPO, the company's shares are typically held by founders, early investors, and employees. After the IPO, these shares can be bought and sold by the public on the stock market, providing liquidity for existing shareholders. Increased visibility and credibility. Going public often brings significant media attention and increases the company's public profile and brand awareness. The scrutiny and regulatory requirements associated with being a public company can also enhance its credibility and transparency. Exit opportunity for early investors. An IPO provides a way for early investors, such as venture capitalists, to cash out their investments and realize returns. Employee stock options. Public companies can attract and retain talent by offering stock options to employees, aligning their interests with the company's success. The IPO process typically involves several stages. Selecting an investment bank, merchant banker. The company hires an investment bank to advise on the IPO process, determine the share price, and underwrite the offering, guarantee the sale of shares. Due diligence and regulatory filings. The company and the investment bank conduct thorough research and prepare necessary documents, including the draft Red Herring Prospectus, DRHP, which is submitted to the Securities and Exchange Board of India, SEBI, for approval. Price determination. The company and the investment bank decide on the price at which the shares will be offered to the public, often through a process called bookbuilding, where potential investors bid on the shares within a price range. Roadshow. The company's management and the investment bankers conduct presentations to potential institutional investors to generate interest in the IPO. IPO launch and subscription. The IPO opens to the public, allowing investors to bid for the shares within the specified price band. Allotment of shares. Once the subscription period closes, the company allocates shares to the successful bidders. If the IPO is oversubscribed, receives more bids than the number of shares offered, the allotment is often done on a lottery basis for retail investors. Listing on stock exchanges. Finally, the company's shares are listed and begin trading on the stock exchanges, allowing investors to buy and sell them in the open market. For companies, the benefits of an IPO include access to substantial capital. IPOs can raise significantly more funds than private funding rounds. Enhanced public image. Becoming a public company can boost a company's reputation and make it more attractive to customers, partners, and future employees. Increased liquidity for shareholders. Existing shareholders gain the ability to easily sell their shares. Potential for future fundraising. Once public, the company can access capital markets more easily for future fundraising through follow-on offerings. Use of stock for acquisitions and incentives. Publicly traded stock can be used as a currency for mergers and acquisitions and as an incentive for employees through stock options. In conclusion, an IPO is a transformative event for a private company, providing a pathway to raise capital, increase its public profile, and offer liquidity to its shareholders. It's a complex process that requires careful planning and execution, ultimately leading to the company becoming a publicly traded entity on the stock market.